Good morning, everyone. Today is the second series of the On the Go, where I share some of my thoughts while driving to work. And today I wanted to discuss the returns on investments in properties on the Kenya market. So they are, when we receive new customers, we normally qualify them, and one of the necessity of qualification is to understand the reason of why people want to buy real estate. There's quite often, let's say 20% of all customers are saying that they want to do an investment. And that's the reason they inquire about some certain apartment or house or even land. So for this one, today I wanted to check on which is the most profitable or more secure, more safe type of investment. Let's do one by one. So you need to understand, when you invest in property, especially in the finished complete property ready for occupation, there are two types of income you can expect. One income is rental income, and the second type is capital growth. So you need to take into account both of them in order to make correct calculations and do your financial planning. Let's do one by one. So when you buy empty land, you can expect only capital growth, unless some cases where the land is located near the major highways or any other well placed positions for logistics. You might even consider renting an empty plot as a yard. So there are some tenants looking for empty plots, especially if they already at least have a simple fence. Second option is when you have okay, just a moment, I found a cameo on the road. Let me try to save it. Imagine I was not able to locate the cameo. I just saw it. I parked the car just 15 meters after. So by the time I came out, I can't see it. So maybe it's masquerading itself so well against the grass or what, but I lost it. Anyway, at least it's safe because it was crossing the road. Let's continue. So second option of earning on your empty land is when it is a farming land, so you can also lease it as a farm. Leasing as a yard can give you higher rental income. Farming, normally not so high income. And normally your land is even not fenced and all that. But for land, you can expect capital growth, and always just remember the usual real estate rule, which is location, and one more time, location. So if your location is good and the land prices is not yet overpriced, land prices are still reasonable, you will expect good capital growth on the land. Especially you can pay attention to areas which are not yet open for development but will be open soon. You can follow the messages and articles from the government about where in future they plan to develop some roads, where this and these developments will be happening. So, and it's good to go there in advance. As soon as roads will be added, and power lines, water pipes, the price of land normally shoots quite quickly. That's the main reason, because in many areas of Kenya the land is undervalued. At the same time, there are many areas where land is overvalued, and where the price is already high, and you don't see that the area will be will continue gradually developing. There's no need to buy there unless you have a personal attachment to that location. So if you see some, for example, if Mombasa, maybe you want something, you like something in Kizingo, or you like a plot in Nyali, you need to understand it's not about investment, it is about your own personal feelings. So it means in future you feel like happy to live there yourself. You want to put a family house, or you want to put something else, but you have a personal feeling. So it's not about capital growth. We also, for land, we remember that there's a possibility also to develop, but let's leave development aside. It will be another topic for another on-the-go series. Okay. So now let's go to the houses. Houses, they have relatively low return on investment in terms of capital growth. Might be not so good unless you buy in the area which is not yet developed, but that gives you some risks in comparison to land, because land you have only land rates and sometimes land rent, depending on if you're buying a free or leasehold. But for a house, there's also keep in mind maintenance costs and security and some other things. So you don't want your house to deteriorate quicker than the capital grows. For apartments, rental income in comparison to the price of apartment, income is normally higher. You can expect roughly around 13% per year of an income. Between from 7 to 13% of per year, based on initial cost, location, and those. So normally the rule is the cheaper the apartment, the higher return on investment you are getting. So if your portfolio is not big yet, it is wise to invest into 1, 2, 3 low or middle income apartment, and instead of buying premium flats. For apartments, same as the houses, if you buy in location which is undervalued, you expect higher capital growth. You need to remember, when you expect high capital growth, it means for the time being you will be getting less rental income, because people most probably don't want to live there, as infrastructure is not yet that good, logistics, access to transport, some other things, maybe water shortages. So rental income will be a bit less, but capital growth potential might be very high. So all those you need to take into account. You spend some time or get advice from a property consultant. Maybe you'd like to even call me and discuss. I'll give you some advice. What are your thoughts on how good is property investment from the point of view of return on investment? I would like to see your comments. If you feel that something I'm telling which is not wrong, which is not true, I'd like to hear also that in the comments, and I'll try to reply each of you personally. Thank you for watching. I'm waiting for your likes. Subscribe for the channel, because we are going to give you many more videos in the near future. Bye.